Looking for income in retirement? Well, look no further than closed end funds. We all know that investing, there is no such thing as a free lunch. So join me today as we talk through why we may want to consider closed end funds, some of the risks involved, criteria to evaluate these types of funds, and insights into what I'm personally doing right here in the red zone. Much like we know that there is no such thing as a free lunch, we also know to ignore what people say, but watch what they do. For example, most people would say that they plan to retire at age 65 or that they'll never be able to. But in fact, the average age of retirement in the US is only 62. So not only will we need additional income at our traditional retirement age, we will more than likely need additional income to bridge to our Social Security claiming age, or even more if we retire earlier than the current average of 62. Before we dive into closed end funds as a potential income solution to these challenges, for those who are new to the channel, in 2024 I entered the red zone, defined generally as that period 5 to 10 years before and after retirement, where I began to make changes to my portfolio to provide a more consistent income and also minimize my exposure to sequence of return risk. I created this channel to share what I've learned. If you like this type of content, please subscribe to the channel so that you can continue to get it right here. One investment vehicle available to us as retail investors that helps provide that needed income in retirement are closed end funds, which are actually older than the open ended funds that we are most familiar with. In fact, we're so familiar with them that we don't even call them open ended funds. They're just funds that we've already invested in. A closed end fund raises a fixed amount of capital through an IPO and then trades just like an ETF. Unlike our open ended funds, closed end funds don't continuously issue or redeem shares. Their total share count is expected to remain fixed, where the more commonly invested in ETFs create new shares as new investors enter the market. Some of the positives of closed end funds, or CEFs for short. First is obviously the income, which is the reason that we're interested in them in the first place. Consistent yields of 8%. So we either need less accumulated dollars to generate the same income if we were planning on following a 4% withdrawal rate, or to simply generate even more cash from our assets. Second, CEFs allow you to access alternative asset classes. Now, the word alternative almost has no meaning these days, as it's generally used to refer to anything that is not a stock or a bond. However, prior to learning about closed end funds, most retail investors are not even aware of the world of credit, senior loans, or collateralized loan obligations, CLOs for short, which we'll probably cover in later episodes. In the meantime, closed end funds can also trade at discounts to the value of their assets. Open ended funds may have a small tracking error, but the discount on CEFs is simply the price below their net asset value. Finally, on the positive side, is that CEFs can and generally do employ leverage, which tends to increase their returns during bull markets, positive macroeconomic conditions, or interest rate levels that are favorable to the fund's underlying assets. Now, for the downsides, CEFs employ leverage. The late Charlie Munger, Warren Buffett's lifelong business partner, told us that there are only three ways a smart person can go broke: liquor, ladies, and leverage. Just like leverage can boost returns when conditions are right for the fund, it generally magnifies losses when conditions are not awesome. Here we are mostly talking about a loss of value or a depreciation in price. The actual distribution may or may not be cut as a result. Some funds pay a consistent payout, while others pay a percentage of net asset value that's recalculated at various points of the year. Which brings us to income cuts. Although some CEFs do increase their payouts, paying out the exact same amount every month for over a decade is quite common with these investment vehicles. During favorable conditions, some funds pay out special dividends, and during bad times, many funds retain their base dividend, with only a few usually that are forced to cut. Those consistent payouts during bad times, however, can contribute to our next potential downside, which is NAV erosion. Net asset value or NAV erosion is consistently discussed within the framework of covered call funds, but it's also present within the CEF investment vehicle. It generally means that the value of your investment is declining over time due to the underlying assets losing their ability to cover the payouts. The overall asset size of many CEFs is smaller than the majority of our at least more commonly known open ended ETFs. When you do want to sell a CEF on the lower end of assets under management, or AUM, you have increased risk of finding a buyer, which is another contributor to CEFs trading at discounts. So, how do I evaluate CEFs? First, I encourage you to do your own research, and there are a few sources that do a great job, including numerous analysts who write for Seeking Alpha, as well as the Contrarian Outlook. I'm not affiliated with any of them, I just find those sites useful. The links are in the description below, as well as links to CEF evaluation tools and websites that I will use in the remainder of this video. Here's a list of the top items that I generally include in my evaluation. Feel free to leave a comment if you feel there's something that I'm missing so that we can continue to help out the Red Zone community. I'm going to cover just a few of these by walking through an example. This is obviously not a full analysis nor an investment recommendation. For our example, we'll use the Adams Diversified Equity Fund, ticker symbol ADX, which was established on October 1st, 1929, just 27 days prior to the stock market crash, coinciding with entering the Great Depression, and it is still around almost 100 years later. As an income investment, we're not overly interested in price appreciation. We are interested in income, and therefore we're interested in total return that accounts for both the distributions paid as well as the appreciation of price. If we see a significant difference in a comparable open ended fund, that could be a cause for us to keep shopping. Looking at ADX, its total return actually beats a comparable open ended fund with similar holdings, an S&P 500 index fund, which could be due to the weightings of its top 10 holdings or its higher payout or the timing of capital gains the fund is triggering. Next, let's talk about discount. First, there may be a good reason that something is on sale, and that reason may not be a good thing. However, most high quality CEFs will often trade as a discount, and it's more about how much that discount is relative to its usual premium or discount that makes it a potential buy. If we look at ADX's price to NAV chart over time, we can see that although ADX is currently trading at discount, its historical discount is usually a little bit bigger. Next, dividend history. What we're interested in here first is how long the fund has consistently paid dividends and if there have been any cuts. If there were any cuts, how long did it take before the dividend was increased back to the previous amount? ADX's dividend chart is a little more complicated at first glance to decipher because, unlike a totally unrelated fund with different underlying assets, ADX's is a little all over the place. Historically, it looks to have paid out four small quarterly dividends with a big end of year special dividend. For example, in 2024, it paid out a year end special distribution of $1.96 per share. The fund generally aims to provide a minimum annual distribution rate of 8%. However, when I evaluate a fund, the fact that it is paid a special dividend only matters if the fund does so regularly, and ADX seems to do so, which I like. If there is a fund that looks like this where it pays one special dividend, I like the fact that it could happen, but since I probably didn't own that fund at the time, it's more annoying when looking at a graphical depiction, or if it happened recently, throws off the standard websites that calculate trailing yield and retain special dividends paid in the numerator of the calculation. Since I don't factor those in when I'm calculating the yield, it causes me to do a little bit of work. Next, liquidity. At a minimum, we want to check assets under management or AUM. A good rule of thumb for me at the current size of the market is that I prefer funds over 500 million in assets to try to prevent any potential liquidation issues. We can also take a look at daily trading volume if we want to get a better idea. So, reading analyst comments, doing my own analysis, and weighing these various options, I found enough closed end fund opportunities over the past year where I currently have about 5% of my total portfolio currently invested in these vehicles. And as I transition to a red zone portfolio, plan to move to approximately 15%. So, are closed end funds right for you? As we walk through various sectors and asset classes we want to invest in for income and to control our portfolio's volatility, we'll continue to see CEFs as options. If you're interested in specific tickers as well as what's in my own portfolio, we'll continue the discussion next week right here in the red zone.